From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, June 4th. You're listening to the Macrocast on Jobs Day. An interesting Jobs Day today. We had, numbers somewhere, within the range of expectations, but still a lot to dive into for us today. We have John and Brendan from Markets Policy Partners with us in DC. Stratton Kirton with us today, making one of his Macrocast appearances on Jobs Day. We love to have Stratton with us. Stratton, why don't you take us through the top line numbers on this? I think there's a lot for us to dig into today.
Absolutely. And Tony, I think you nailed it. It's kind of within the range of consensus, but on the low end of the range. So the non-farm payroll rose by 559,000 in May, and that had unemployment tick down to about 5.8%. And just to put that in context, the Dow Jones consensus was around 671,000. So a little below that, but still a significant improvement over April, where we saw, less than half of that. And we saw the unemployment rate stay flat and not a lot of other good things to highlight last month. I would say overall, it was a mixed report. In my book, it seems like the positives outweigh the negatives a little bit. So we saw unemployment tick down, as I mentioned. We saw hourly earnings tick up. The total number of unemployed people ticked down after it was stagnant last month. And then we saw a decent drop in the number of long-term unemployed, which, is always a significant challenge, coming out of recessions like this. And then, a little upward revision from the last 2 months, about 27,000. And, if I'm the Biden administration, I hope those upward revisions continue over the next few months. On the downside, labor force participation rate, actually ticked up a little bit. So be pretty stagnant there. And so, like I said, in the consensus, but on the low side, and then, some other interesting things to jump into, but that's the top line.
Yeah, it's the most interesting thing that I found is, so in the household supplemental data, so we get two reports, the employment survey, which you ask employers how many people, and that's how we get the jobs number, which was, a little under 600,000. But then the unemployment rate comes off of the household survey. That's where you actually call people. And that's but within that, they also have a measurement of how many people are employed and unemployed. And in that, they said that 7.9 million persons reported that they had been unable to work because their employer closed or lost business due to pandemic. That is, they did not work at all or work fewer hours at some point in the last 4 weeks due to the pandemic. That was a bit shocking to me.
Yeah, I think it's still a troubling number. I mean, just the numbers in context, again, like we're talking about, 560,000 jobs being created, in normal times. Obviously, that's in blowout category. And again, the April numbers with those are tiny revisions for both April and
I was actually more interested in the revisions than I was in what this number was.
So if you were looking for something, I mean, so last month's numbers were such a disappointment. Again, they were the kinds of numbers at 270,000 roughly that was steady as she goes for job creation in what we were seeing pre-pandemic of we would consider that a very solid number, but it turned out it was a very disappointing number. One of the things we were looking for in revisions were a lot of hopefulness that somehow the establishment survey had missed 100,000 jobs somewhere, and they really didn't.
And then also when you look at the unadjusted numbers, so on a seasonally adjusted number, we created 559,000. Normally in May, we create somewhere between 700 and 900,000 jobs, and then we seasonally adjust it to usually 200,000. This month we created 793. Last year we had 3.1 million. But the point is that the seasonal adjustment wasn't crazy wonky. Maybe it's off by even 100,000. Doesn't really matter. It's not like we created 3 million jobs and it got seasonally adjusted down.
Right.
So, and we want to get into some of the other, some of the elements in there, some of the clues in there that we're seeing on the economy. The two that stick out to me, and tell me what you guys think on both of these. Well, one is labor force participation rate, still I mean, obviously historically really low. Like you actually have to go back to I think the 70s before women really started, we're starting to enter the workforce to get to such low labor force participation rates. Needless to say, if more people were participating in the workforce, the unemployment rate would be significantly higher. Is sort of like looked at just the average of participation over the past 10 years or 15 years.
Which is also screwing a bit with a lot with the actual unemployment rate. The unemployment rate is understating the reality of what's going on.
Exactly.
Absolutely.
Yeah. But it does tick up a little bit. I mean, I guess that's a good sign. But I think we all hoped for a rapid return that didn't have where the economy wasn't going to have business cycle characteristics of return to work, because we make this presumption that there was this sort of an administrative act that we were waiting for that will allow people to go back to work, and it's tied into policy on the number of people that you can have inside establishments, vaccination rate, allowing people to get back to a normal way of life, rolling off the CDC guidelines on mask wearing, things like that inhibit a lot of work. And while that was I'm going to say that was a solid number today, and I'm optimistic about the direction, the way things are going. If we keep getting numbers in that range for the next few months, that's great. What if we peaked though? Where a couple months ago we had 700,000 jobs. What if we're like, we saw on the downside, losing jobs at 1 million, rate of 1 million a month. We're not going to see. I think we should disabuse ourselves of the idea that we're going to see 1 million jobs created in a month.
It was interesting. And Stratton, you can speak to it too, because you're at the office. So I was in the office yesterday. Our office is in downtown DC. It's 2 blocks away from the Treasury and the White House. Hamilton Place Strategies went back to the office 2 days ago. And you have about 50% of the people in the office. You're an outlier. Most businesses, not just in DC, are going to wait until September till they're there. When I went out to lunch, I had very few options because there's just not enough people in offices to support all the service sector, restaurants, and ancillary businesses.
Absolutely.
So it made me both optimistic and a little pessimistic it made me optimistic about the long term. Once we get back to the office, these businesses can open, but I don't think we're going to be 100% in the office until September.
I think that's absolutely right. And I think the data also reflects that. We saw telecommuting reported down by 2%, but I think still 15% of people, said they're telecommuting. So it wasn't a huge change. If you think in your head that everybody's kind of getting back to normal. And I absolutely agree. I think September, for Tony's point, will be the make or break moment of being able to tell, are we going to have a really hot economy that's going to get us back up to full employment, or at least pre-COVID employment, or are we kind of going to stagnate because everything's going to come together then, right? Federal unemployment benefits and children go back to school. Schools hopefully almost everywhere.
Knock on wood. Knock.
So childcare, which remains a huge issue for some people going back to work. We'll have more people vaccinated, not just first doses, but hopefully getting close to that 70% mark for second doses. And, the other thing is we have 25.
We get free beer if we get to 70%.
Well, and, a lot of attention and ink has been spilled on the 25 states or so that are now rejecting the extra federal unemployment insurance. But we should remember, none of that is reflected in what we're seeing now, because people still have the opportunity to look for work. They're just going to have to prove they're looking for work. And then as those people go back to jobs, we'll still see that number ticking up over the next couple of months. So I think I'm in the same place as all of you guys are, that I'm optimistic, but I think we really won't know until we get the September numbers.
Yeah. And I think we'll continue to see wage increases in the next few months. It's just going to be harder to convince people, especially at the low end, to come back to work.
Yeah.
One of the things that we did see in this is, again, some pretty powerful lift on wages. again. So, and again, like we should always have to preface by saying no one here is opposed to wages increasing. We're all pro wage increases wherever you can get them. But there are anomalies in this too, right? I mean, if there are disruptions that are causing wages to increase, that are, again, it's not normal business cycle kinds of things.
No, and we were talking about this before the podcast, that coming out of this isn't a normal, economic regression analysis. This is really a psychological, sociological analysis. And like, I think people are going to work from home on Mondays and Fridays where we didn't normally do that. So the pandemic is going to cause shifts that we went through a year and a half of working from home. So your view on life changed. It doesn't worry me, but what I think could happen is a lot of people realize maybe that working for $12 an hour isn't all that different from being on welfare. So you might as well just not work for $12 an hour. So
we'll see whether that's the case. I hear anecdotal evidence of that, and I wonder. We said that, said this before. I'm going to agree with you to a bit on this.
Yeah, and I'm overstating it, but you get like I think you're going to have to pay more at the low end.
Really don't. Yeah, then the truth is we really don't know. Yeah. And again, as I always have to remind myself in saying that, I say today that impact is minimal. It's not as powerful as anecdotes tell us. But at the same time, I always remind myself is that I was the one saying that, the supplemental benefit was important because we wanted to incentivize people to stay home. So if it was an incentive for them to stay home,
people to stay home. Yeah.
Right. If it was an incentive a year ago, how can it not be a disincentive today?
Right. And an extra $600 a month on top of your unemployment, that was like $1,200 a week. That's a lot of money. Now it's $300. So it's not a ton extra. And also you're not on initial claims anymore. You're on continuing. So, you're talking about like $500 a week. It's not a ton of money. I think people are a little overstating how much you're getting from your extended unemployment benefits.
I think so too. And because what I would also add more nuance to this is just the scale of the state benefits that's on top of is huge, right? I think Massachusetts is at the top with $855 a week eligible up to, and it goes all the way down to 300,
300. Yeah.
Like it hugely variable based on what state you're in. I thought the journal, I feel like a lot of nuance has been missing from this conversation broadly when people are talking about this. And the journal's preview piece of the Jobs Day report yesterday did a good job. They were talking to an events organizer and what are the barriers she's facing to getting people back to work. Some of the ones you expect, people still concerned about COVID, people concerned about, childcare arrangements. People have moved during the pandemic.
Yeah.
You can't just bring back the same old employees. You have to find new ones, train new ones. And then the other thing she said was, some of the employees are asking for higher wages, not just because they want higher wages, but because their job is more complicated now. Before it used to be a straightforward, and this might be, just a microcosm for the events industry, but a straightforward doing things in person. We know how to do it, but now it has a lot more of the technological element, broadcast element, hybrid element, and that's just much more complicated. So people are asking for more compensation.
Yeah, and that's a risk factor. I mean, there's just a greater appreciation of person to person facing jobs have a completely different risk profile than we used to imagine them, and workers tend to get paid a little bit more for extra risk, complexity, risk, those and the employer costs to ensure the safety and hygienics of their workspace and that sort of stuff. Those are raising costs as well. It's a very interesting mix, and we'll talk a little bit later about how this plays into Fed policy ramifications. But
maybe now is a good time to talk about.
Yeah, I was going to ask you, John. Is there anything in here that you saw that gives the FOMC a different outlook?
Well, we had, when Brendan and I were talking about this prior to the number, we basically said after the April jobs data that came out with a crashing disappointment, as we discussed, the the Fed has 3 more non-farm payroll numbers until the August symposium in Jackson Hole, and there'd been a lot of speculation.
Which is going to be in person. We got that official.
Yeah. So that's exciting. They'll be out there cutting a sort of uncertain outdoor figures in their jeans with like creases in them still.
Steve Lee's to get his fly fishing in.
That's right. But it's been the venue of so many big policy shifts for global central bankers over the years that it's just natural that investors would focus on it for the potential announcement of a taper, or at least a process and a timeline for the taper of the quantitative easing program that is still full blast, $120 billion a month. And Brendan and I basically said, if you imagine that they're going to be tapering at that meeting, you have to have 3 non-farm payroll numbers basically knock it out of the park between now and then. And we just got one of those 3 come in on the light side. And, these kinds of cross currents and uncertainties that we've been talking about, these are not any clearer to the Fed. They are in unprecedented circumstances as well. They've said as much. The uncertainty level is high. That's why they keep focusing on, we need to see the progress. They're Missouri. They're in the show me state. We got to see it rather than project it. And that is, that's where the majority of the committee is. And that's even where the hawks are. We've seen over the last couple of weeks a lot more discussion, talking about tapering. And but it's always been, covered in bubble wrap, even from the more hawkish members of the committee, saying that they're not advocating a taper. They're just advocating a discussion about it at some point in the not too distant future, assuming that growth and economic data still looks really good and the recovery is in train. That is. That tells us that, our base case for a much later in the year or even early next year start to the taper is probably certainly more likely now. But that's been our base case for a while.
And it seems like that's the way markets are looking at it as well, too. If we just think about early reaction. The
dollar's now off. So this is also a counterpoint to yesterday, and this talks to the uncertainty and noise in the data. The ADP compiled jobs number was awesome yesterday. It was like 1 million jobs. Yeah. And the initial jobless claims for last week, those came down. The improvement was better than expected. And so these trends are all looking great. And they're not being validated in the non-farm payroll number. But as Brendan, Stratton, and you've talked about, Tony, the non-farm payroll number has a lot of different moving parts. Yeah. And so, to get the baseline reading at a time like this is really hard. And the Fed has basically, expressed the intention to wait it out until they get better clarity. And so,
it seems like this is just steady as she goes, right? I mean, they're going to be in this same pedaling at the same speed.
Yeah. We've seen longer dated treasury yields basically flatlining for the past couple of months. And we've seen, the yield curve, the same kind of sideways price action, very narrow range. The dollar is loitering around 4-month lows, doesn't seem to be getting any lift here. And because of this chop, and the prospect that has, dwindled a little bit today of a more near-term taper of QE. This is pretty steady as she goes. It fuels risk assets. We're obviously seeing outperformance in sort of the tech and the kinds of parts of the risk asset complex that respond to elongating expectations of ultra accommodative monetary policy. Less good for your real economy stocks like banks and industrials.
Yeah, and those rates are just going to stay low, and so again, like more challenging environment to make money if you're a financial. The 10-year seems like there's a gravitational pull at 6, right?
There really is like the stasis has been pretty impressive here in markets, and so there are lots of bets. There are lots of bets that the yield curve is going to steepen. That's our base case as well, that the economy does heat up over the summer and that the equanimity in the treasury market eventually gives way to a relapse into a steepening trend. As the economy really does, the gears start to catch, and we look back at kind of this springtime non-farm payroll lull as more of a blip than really a serious soft or a serious downside to the
hope that's the case. Yeah, I mean that's what we want to see, right?
Yeah.
Right. And the best case scenario is the data forces the Fed to taper and raise rates.
What you'd rather see. I mean, what you want to see is that's right. You want to see them pull the Fed being pulled, not the Fed pushing. I think,
and not because of asset bubbles that they're pulled into it.
Yeah.
Or very high inflation.
And this job number, not just. And this jobs number is playing out against a backdrop of the negotiations of the American Jobs Plan. Which is something that is obviously a lot of debate about, and this the prospect of a big infrastructure package being something that does eventually materialize and is a source of hiring at a time when the labor market is really tight. It'll be interesting to see how the macro threads kind of intersect on that.
One other note coming out of the report, John, which was that construction jobs were down by 30,000 or so. Have we peaked on? I mean, has
we literally just don't have enough people to do it.
Yeah, is that the problem? Yeah, I mean, it's interesting. I mean, we've seen just looking at data on building a home. Right. I think I can't remember who it was. Somebody did an interesting analysis on just about everything that goes into building a home. We were going to talk about lumber. Everything that goes into building a home is more expensive right now, and
by double or triple of what it was a year and a half ago.
And again, we have to remember there's a big lag, right? People are talking about the tightness in the housing market right now because the homes that are being built as a result of that indicator aren't going to be on the market for 18 months. I might be in a weird position for this because I was talking to a home builder recently, but taking Bethesda, Maryland as an example, you're knocking down an old home to put up a new home. That right there, just from a regulatory standpoint and licenses is 5 to 6 months. And then you add 12 to 16 months to build the home on top of that, so add that.
Yeah, but look, there could be, we'd look to see it confirmed next month or so. But still, none of that explains losing 30,000 construction jobs.
No, well, and the industry's still way down from pre-COVID. It's down by more than 200,000 pre-COVID.
Right. So
a lot of that actually has to do with demographics. Is the birth rate in Mexico went from 7 children to 2, and it was right around the financial crisis in 2008. There's just less immigrants coming to America, and while we make a big deal about it's a political issue, we really need more people to come. But whether we want them or not, there's actually much less Latin American immigrants coming than there was 20 years ago.
Some of us still want them. We want them.
I'm a
lot of them. Yeah, we want a lot of them. Yeah.
Another interesting wrinkle to this is I was talking to several executives in the construction industry, and one of the things they were saying is it's really hard to attract just young people to the industry because it is one of the least digitized industries in the country. So to just appealing to the demographic change, that's a big hurdle that they have to get over.
That's fascinating. All right, guys, let's come back. We're going to talk about some, more fun in, meme stocks and market activity this past week. We'll be right back after this.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All right, we're back on the Macrocast. Guys, AMC movie theaters, I just said, I don't know if this means I'm conflicted, but, I am an AMC, Stubs member. So I do get the benefits of AMC movie theaters, getting back, staying in operation and bringing great movies to the big screen for me. But that's not to say that they're going to be a huge going concern going forward. We'll see. But they did something interesting this week. their stock is going, up and down all over the place. They issued, which, a lot of people said, looked at like this phenomenon of interest in these shorted stocks coming out of COVID, and with their prices elevated, people saying, they should be out, they should go issue, right? If the market's there for it, go issue. And they did that this week, issuing 25 million shares, which they sold to a hedge fund.
Yeah, Merrick Capital. So it's not all retail. The sophisticated investor put $230 million in this.
Well, how do you see this, Brendan? What's going on here?
It's utter fascinating from a whole host of perspective. But just to explain, AMC now has $800 million in the bank. So they can do with that what they want.
They have debt also, don't they?
Yeah, a huge
$2 billion worth of debt.
Yeah.
Yeah.
And that's the two channels that a company has to, fund themselves. You can issue debt, which you have to pay back, or you can issue equity, which you sell a percentage of your company. So existing shareholders just got diluted massively. So if 20 new million shares came in, so you own less of the company, but a year ago the company was bankrupt. So it's balancing whether you want to own more of a company that was bankrupt or less of a company that now has
you're throwing bankrupt around in the sense that they didn't have anybody buying tickets, but they weren't technically bankrupt, right?
No,
reorganization.
Yeah.
Right?
I mean, when in the midst of the pandemic, everyone's like, movie, they're screwed. Yeah,
that's right.
But they did a pretty good job.
What's stopping them from just taking this? What did they make on it? What did they make on this sale?
$800 million.
800 million. Paying bonuses to everybody and going into bankruptcy.
So shareholders still have a right, and I don't think that the company wants to do that. They want to have a future and sell movie tickets and have
the irony with
but they could
versus GameStop. Yeah, so like GameStop, they actually have. Look, it's you never know, right? I mean, people say we've got a strategy. They brought in this other guy from what's his name?
Yeah.
From the other company, whose name I'm forgetting, but he's run a successful company, right? A digital brand, and so maybe turn. Right. There's a strategy and a plan there. What's the strategy for it? What do they do with $800 million? They could pay down debt, right?
No, but it's a really good point. GameStop has a chance to pivot. They can go from being in malls and you buy actual things and to try to be an online, provider of games. A movie theater, I don't know. You're just a movie theater. Either you go.
Yeah, that's what I want. Like you can imagine. We haven't heard the story, right? But you can imagine a future where you make movie going a premium enterprise, right? That's one way to do it, right?
And that's what they were doing before the pandemic, because less and less people were going to see movies. Now you have the reclining seats that you can have a beer and dinner.
You can get a drink. They're people experimenting with subscription plans, better seats, and the lounges and all those kinds of things. Like these are all things that they can do, and maybe just do them in a bigger, better way to attract people who are going to, instead of spending $50 when they a couple goes to the movies. You figure out a way for them to spend, $75 or $80.
Yeah, exactly. Yeah.
Right. That's the trick, is to get people to want to go to the movies as a destination and spend a lot more money. But we're not hearing any of that, right? We haven't actually seen any plans.
No, they haven't really said what they're going to do with this money.
Now, they did say something else, though, on their issue, is that they said, you can't trust any of these valuations. We're in a market where we don't know.
That's an SEC issue. Yeah, they said that we do not think that the value of our shares reflects the underlying value of our business. And still, people gave them $800 million.
Have you ever seen anything like that before?
Never.
I never have either. And I'm not even sure.
I've seen IPOs that were overvalued, but never never a company.
Never where the company is.
We think you're an idiot for doing this, but we're going to do it.
It's just like a big shrug emoji, you know?
Yeah.
So,
and Michael Jordan's a security guard.
Yeah. Regulators are certainly, rolling their eyes looking at this. But one of the things that we've heard pretty consistently is that, they're focused on kind of the ancillary aspects of it, whether it's the way that Robinhood does the no fee, their sort of no fee trading, the disclosures around these. It's you can't regulate so that people aren't able to talk about stocks they like on Reddit. Yeah. It's just, you can't, that's behavior you're not going to be able to stamp out, except for, even in the most egregious like pump and dump cases, but this is just not that. And so you end up with regulators trying to look at some of the other issues that are perhaps implicated by this. And that really is, the ability of these platforms to sort of gamify investing, and to the extent to which, investor protection is put on the line with some of these practices. They don't have the answer to that, but that's certainly something they're going to be looking into. The role of short sellers and how how markets operate. It'll be much more of like a market functioning inquiry rather than a let's stop the meme stocks thing. Policymakers just can't pull that off.
There was a lot of funk in this week too. I mean, so like I do think that, that was clearly a GameStop story. I do think there's some of that in this, but there's more. I mean, there was a lot of action in options markets this time with AMC, and still is. You had this unique situation of this one fund, essentially buying, a huge amount of the shares and reselling them in, a couple days time. Right? I mean, they've announced yesterday they own no more AMC stocks. That was a nice arbitrage for them. Just like weird, a lot of weirdness around this that we've never seen before. No one has ever seen any of this kind of week with a single stock, and where the stock is going from. Like, we've seen stocks that go way up and way down. We saw this stock go up, down, up again, down again, settling up something up, up again, like on a daily basis, and not by little amounts, by 25%, 15%, 95%, just like really weird up and down action. And it makes you wonder whether, what's going on with market makers.
No, it's a really good point, because
is it institutional or is it?
You can have tech stocks or biotech stocks that have a technology that people think in the 10 or 3 years in the future it's going to be game changing. So the actual value of the company is way beyond what their current earnings are. You don't usually get that in a bricks and mortar company where they own X amount of real estate and they make X amount of dollars. Like, I don't think anyone's thinking that AMC is going to be the next Google or whatever. It's going to be AMC next year,
Yeah. Well, I hope so. Again, as an AMC subs member, I really do hope that they are still AMC next year, and I could still go over to the Lincoln 13. And
I love the Lincoln.
I love it. Yeah, it's the place to be. Let's come back and take a look at next week. And by the way, I do think there are going to be a lot more on this AMC story as it goes forward. We'll keep track of it. But let's take a break now and come back and look ahead to next week. You're listening to the Macrocast.
Check out HPS Insights, a regular podcast from Hamilton Place Strategies, bringing you the latest on policy debates affecting the business and political communities. Available on the HPS podcast channel on your favorite streaming platforms, including Apple, Spotify, and Google. Tune in to the latest episodes and learn more at hamiltonplacestrategies.com/podcast.
All right, back on the Macrocast. Brendan, we have a little bit of data next week, right?
So the big data event is the CPI for May. which obviously is a very important part. The Fed targets the PCE, but the CPI, a lot of the components within the CPI are fed right into the PCE. So it gives a sense of what's going on in the inflationary environment, which is really the probably the main topic in terms of Fed decisions going forward. And then the Bank of Canada and the ECB also have an interest rate meetings.
Yeah, I'll be interested to see ECB next week. They're still dealing with a lot in a very uncertain environment that they're in.
Yeah, the vaccination efforts throughout Europe is very uneven.
Very uneven, yeah. And so therefore their return to economic activity is very uneven as well.
Yeah.
All right, guys. Stratton, great to have you with us on Jobs Day again.
Thank you, as always.
You know, Stratton, I want to have you back to talk about energy. Yeah, I think we're going to do maybe not next week, but the following week. I'd love to have you come back. And just Stratton, for listeners' knowledge, is one of our energy experts at HPS. There's a lot to talk about, both in fossil fuel land and on alternatives and what's going on with climate legislation and other things, and there are some macro implications for that. So I'd love to have you back and get into energy a little bit. But thanks for being with us for Jobs Day again, as always. John, Brendan, everyone have a great weekend. We'll see you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.